Andrea, thank you for joining us. Tell us a bit about the evolution of the infrastructure secondaries market.
Yeah, so the infrastructure secondaries market really started to emerge back in 2010. And the driver there was really LP dissatisfaction coming out of the global financial crisis. Some of the funds hadn't performed in the way that they expected to, predominantly because of over leverage. And so we started to see distressed sellers and funds selling at a big discount. But it was a fairly limited market at that point. The market's really matured over the last, well, I guess decade now, but the last 5 years in particular. And it's been driven by the underlying growth in the unlisted infrastructure fund market. So we've seen over the last 5 years a 17% CAGR growth in the market and 140 billion raised last year. So it's inevitable with an underlying market of this size. And I believe there's around $500 billion of assets in the ground, that there will be a need for a secondary market, there will be a need for a turnover, even in a long-dated asset class like infrastructure, and that's what's driving the deal flow. We've seen a lot of GP-led transactions, continuation funds and single asset secondaries. They've made up the majority of the market, but increasingly now we are seeing larger portfolios and traditional secondary deals becoming quite an important part of the deal flow as well.
And you mentioned the long-dated nature of infrastructure. What are some of the similarities and differences between infrastructure secondaries and private equity secondaries?
Yeah, we've certainly seen a lot of trends that we've seen in private equity coming through and applying to infrastructure. Infrastructure is a more nascent market, and so we can see and learn some lessons from what's happened in private equity. I think the dominance of GP-led transactions, the best practice in GP-led transactions as well, the single asset secondaries, these are all similarities in the market. I think when it comes to the differences are the underlying assets themselves. We're using the secondary market to buy infrastructure assets, but we really need to be able to understand and value those infrastructure assets. So it requires a specialist team to be able to do that. We do see a lot more concentration in the infrastructure secondaries market than you see in private equity, where that market sees a lot more large portfolios. So I think it's increasingly important to be able to get those cash flows valued correctly. And then I think the other main difference is the market itself. It's much less crowded than the private equity market. At the moment, there's really only a handful of institutional buyers for infrastructure secondaries. And probably only 3 with scale and expertise to do the large GP-led and the $1 billion plus traditional LP portfolios. And I think this is illustrated by what we call the secondary overhang ratio, where we look at how much dry powder is available and shortly to be raised by secondary funds for that market, and what's the annual transaction volume. And for infrastructure, that ratio is 1.3 times. So you could technically, really deploy all of that capital in just over a year, is what that says. Whereas in private equity, that ratio is 3 times, so it would take 3 years. So it's a much less crowded market, which makes it a really interesting way to get access to those infrastructure assets compared to, I think, the direct market, which is, really quite competitive today.
Yeah. So it sounds like there's, growth. There's been growth in the industry. What are some of the challenges and best practice, examples of best practice for dealing with them?
Yeah, I think the challenge is, if we look at traditional secondaries, it's often a lot of detective work. It's not necessarily like a co-investment where you get all of your due diligence information packaged to you in a data room and on a plate. You have to use the benefit of your own platform. We've got a database of 600 underlying assets which we manage, and you have to use the relationships that you have with GPs in the market to do reference calls and collate information. So there's definitely detective work on more traditional secondaries to price them. And then I think when you look at the sort of continuation funds, there are inherent conflicts there. And so it's really important that best practice is followed. And that best practice really means a genuine rationale for the transaction. So it's not being done for the GP's own reasons. There's a genuine rationale for the transaction, and it is for the benefit of LPs as well. You need to bring the LPAC along. You need to involve them early, have their approval, have a process for a fair and independent setting of the valuation and price, and give the existing LPs the right to roll into the transaction on at least as good terms as they're on at the moment. So it's important to follow that best practice, and I think if that's done, it's a very valuable part of the market for GPs and for LPs as well.
And on that, what is the outlook for the infrastructure secondaries market over the next 5 to 10 years, and LPs' appetite for investing in it?
Yeah, I mean, we're seeing increasing LP appetite for it. I think there's a growing acceptance that this is a necessary and important part of the market. There are really interesting portfolio reasons why an investor might want to have secondaries in their portfolio. It helps them to mitigate the J-curve. We've been buying traditional funds at around a 12 to 15% discount, so that's really helpful. You get backwards vintage diversification, which if you're starting your portfolio, and it just helps to get more capital deployed into the market. I think over the next 3 to 5 years, the market is going to continue to grow. And we know that because it's a derivative of the primary market. The primary market's been growing, as I mentioned earlier, at 17% CAGR. It will continue to grow, I think, over the next 2 years. There's no sign of it slowing down. And so the secondary market will grow. We're projecting 45 billion of secondary deal flow over the next 3 years. And I think as we go out further, that will continue to grow. GP-leds will continue to be an important part of the market, both continuation funds and secondaries. And traditional secondaries, portfolios and single funds will, I think, become a greater part of the market than it has been over the last few years. And we're certainly seeing signs of that this year.
Sounds like an exciting place to be right now. Thank you very much for joining us, Andrea.
Thank you, I appreciate it.